Welcome to the podcast. This is Eric Salzman. I'm joined by Richie Bennett and Kevin Doherty. How are we, fellas?
Hello.
Good. Summer started.
Summer
Well,
started and another day of the markets being up, up, up.
crazy,
Yeah.
crazy. Which remember we talked about, and I like the guy. I do think he's sharp. But a couple of weeks back, right, we talked about how Michael Burry, the big short guy, made it unequivocally clear that he was short the market. In case anybody had to guess or not, and that was about 3 weeks ago, and about 20% ago. It feels like, right? Like,
Yeah.
I mean, I don't know what's happened to him, but he's got to be down a lot. If what he implied in that research report, he's pretty short, and he's pretty short the stuff that's going up again. It has to be.
Well,
Richie, is it his dough? Is it his dough still? I mean, does he still have investors, or is he kind of managing a family office for
I
himself?
think a couple years back he stopped. Yeah, I think
Uh,
because he was losing, I think a little bit, or not making as much,
right.
and I'm sure he was getting complaints from clients, and he was just like, "Screw you all!" Like, I'm going away. He probably does still run some money, but I think
Right.
majority is his own.
the whole 6 degrees of separation thing. Interesting little tidbit on Michael Burry. I'm 99% sure that he and I were in the same daycare playgroup when we were like 5 years old, like kindergarten age, because we're from same city, San Jose, lived in the same neighborhood, same age. We actually went to the same college, but didn't know each other there. But my mom remembers that there was a kid in the playgroup that had a glass eye. And so this was, one of those features that came out about Michael Burry. So maybe there was, I hope I should have gone back in time and befriended him
I
and
was I was going to
got
say,
some of his wisdom to rub off.
did you like hang with him, or was he like out on the other side of a playground?
I don't remember any. I have no memories of that early period in my life,
Mm,
unfortunately.
that's funny.
Yeah. Well, I think all of us have traded, so I'm sure you guys have been uncomfortably short at times. And in my failed attempt to be a hedge fund manager, I was very short credit, high yield credit, and emerging like back. You remember they used to call them when Europe was blowing up the pigs,
Hmm.
Portugal, Ireland, Italy, and Greece. Well,
Hmm.
we basically it was 2000, late 2009, and things were starting to pick up again, and we were looking at this going, nah, the market's still destroyed. Like all these, especially a lot of these European countries, like the pigs, like there's no way out of this for them. And so we bought protection, meaning when you buy protection, credit default swap protection on Greece or on Italy, you basically want that you want to buy it and then you want the spread to increase dramatically, which is what we thought happened. And instead, the reverse opposite happened. And I probably spent about 6 or 7 months in these positions. And I remember one time, and this is terrible to think about, but this is how you get. I had to fly somewhere and I got on a plane and Greece was burning. Like Athens was on fire. There were riots I mean, and of course I'm like, yes, it's happening. I get off the plane and the spreads are tighter. Like they went against me more with the riot. But that's when you learned because you remember the Fed and the ECB and all the major central banks. This was when they were really starting to do quantitative easing and all this just stuff where you there was no way you could ever if they wanted something to happen, it was going to happen. If you were in the way of that, you got crushed. And I do remember many days feeling like I was in the fetal position under my desk. So I think that's kind of how Mr. Burry felt during the Big Short.
Yeah,
So
it's
you feel worse being short and wrong than you do about being long and wrong, right? And that's
Absolutely.
pretty.
yeah,
Almost everybody feels that way.
it's a double whammy, right? Because there's
Yeah.
a bunch of people running around when you're short saying, "Dude, did you see how much money I made today?" And you're like, "Yeah, yeah, I saw it.
Yeah.
I saw it." Oh, you're not in? Yeah, I'm in the other way.
Now, to be honest, to be fair, we were a blow-up fund. We basically created this fund so when the poop hits the fan again, you're going to have your hedge. Richie and I are friendly with the guy, the main guy who ran that fund, and it did fantastic in obviously in '07, '08 because everything blew up, and so we were waiting for it to happen again. But people who invested with us, we were kind of the hedge, so they started getting mad at us, and we're like, but we're not like you're making money over there. We're the hedge, like we're the cost of doing business. But no, when the market's going up 20, 30%, no one wants to hear about that you're down five, and we would be down like 3 or 4%. I mean, to think about, we managed it like blood, sweat, and tears to keep around that level and not just get smoked down 20%. And everybody pulled their money. Or most of the guys pulled their money because they were furious that we were losing money.
Mm. Yeah,
But
it's a tough
that's
way to be.
yep.
So here's some news we can all use. 80 years ago today, I think, 1946, the Dow Jones Industrial Average hit a post-war all-time high, I believe, of 212.5, right? So now it's at 50,000. However, it hit that day, and then it didn't pass higher than that again until 1950. So you kind of draw some parallels, right? Like you're sitting here saying, all right, we keep going up, 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 up. What could stop it? And if you think about it, right, back then, 80 years ago, coming out of the war, like the 50s really grew, but the 40s were really building the foundation, right, of all this industrial stuff going on. So there was plenty of good news. So I just saw that today, that fact. So I'd love to find out why. I wonder why from like 46 to 50, it was kind of a no go. There was some kind of bear market in there, had to be.
Yeah, a lot of that was, the boys had come home from the war, and there was additionally, I think, well, obviously there was inflation, right? Because all of a sudden everybody wanted things, but the Ford factory was making B-17s. They were making bombers and tanks and stuff. They weren't making cars. So I think you had a lot of inflation, and you had a lot of angst too, because it's easy to think about now, but back then, what took us out of the depression was basically the war, at least spending for the war when it's even before we got involved in the war, just our production went way up and we were supplying weapons and things to the Russians and to the Brits. But there was a big concern that when all these guys are coming back, and where are the jobs? And where are the jobs? And so there was a lot, and there was some huge strikes. I think there was a big coal strike in '48. Bunch of different labor strikes and stuff. So there was a lot. Yeah, it was kind of a rough. It was that would call it the transition period from war production to getting the economy back online. That's how the GI Bill. That's how it came to be, because they were like, "What are we going to do with all these guys?" Like, okay. So anyway, that's a little history. That's probably what happened.
If you find a book or know of a book that talks about that period, that'd be interesting to read, and we could throw that out as a recommendation.
Sure. Sure.
I know the one book that I would recommend everybody read is called When Money Dies, and it's about the German hyperinflation of
Hmm.
the 1920s, and it is phenomenal because it goes in chronologically, it tells the story of what happened and why people did what they did and what the impact was on different people, different parts of society, and how the trading decisions that people were making, buying foreign currency, buying gold, et cetera, why they would do that or then not do that. And you hear about the hyperinflation. Oh, it's straight line, but no, there were many, many, many pivots throughout
Hmm.
where the smart financial decision that or what would have been the right financial decision a month before, buying French francs, for example,
Right.
then the mark would rally massively for a month. And so, you could get wiped. So people were, it's really hard to stick with a position over years with that kind of
Yeah.
volatility, as I think a lot of people have experienced in their own investing and trading careers. But it's a
Mhm.
phenomenal book. Highly recommended if anyone hasn't
You
read
have
it.
the title again, Kevin?
It's called When Money Dies. And I think the author is Adam Ferguson, I want to say. I've got it right here. But yeah, when money dies.
When money dies.
Hmm.
And I think there's the subtitle, the German hyperinflation. So if you throw that in Google, it'll definitely come up.
Yeah. All right. The other bit of news in the markets, which could, is an interesting. I don't think this guy misses a lot. If you had said this even 20 or 30 years ago, that basically the Palace Station, which is the locals, station casinos are the locals in Vegas. Tillman Fertitta, who had a bug up his butt to buy Caesar's Palace for years, did it. And to show how bullish things are in the markets, he wanted to buy this thing. I'm sure it was a lowball bid, but he was interested in March at around 7 billion he wanted to pay. He ended up paying like 12 yesterday.
Wow.
Yeah. So, the stock didn't go up that much because on the day he said he was interested, he moved it like 20% back in March. So it kind of like it was up like 1 or 2%, but it's going to happen apparently. And if you had told even like 20 years ago, like, yeah, Palace Station just bought Caesar's Palace, people would laugh at you. They'd be like, "No, dude, you got it the wrong way around." Like Palace Station, because the story, his dad was a bellman at the Tropicana, became a dealer, and then tried to figure out like a place to. He basically put this Palace Station. It was called like the casino. I think he called it the casino, and it was like next to a mini mart just off the strip, right? Like so. His idea, and people were like, "What are you doing, dude? You're like a dealer of cards." And he was like, "Nah, but like this is a great place for like people who are in the business can go afterwards, catch a beer and play a little bit. They don't allow them to play at their own casino. This will be." And now he's got he's got 60 casinos in the United States. He also owns Landry's Steakhouse, Landry's restaurant business, which has like, he owns the Palm, he owns Morton's, he owns Del Frisco's. Like, it's ridiculous what this guy, and he owns the Houston Rockets in basketball. So he has clearly pushed dad's money into the
credit card
and gone. Like it's going. So, you wonder like, and that's, I mean, when he does that, right, he's making a huge bet on the Las Vegas Strip and Atlantic City because they own three hotels in Atlantic City, and Caesars owns many hotels on the Strip. And if anybody's paying attention, which I'm sure he is, that trend is not his friend these days, right? Like the traffic on the Las Vegas Strip is down about 10 or 15%. So it's one of the areas that is not booming, apparently.
Yeah, I love. I somehow the YouTube algorithm realized that I love watching these videos about how Las Vegas has died. It's not what it was years ago. It sucks. And I'm actually going to go there this summer, which is not the best time to go, but it's just when I can go. And I'm interested to see how it has changed.
Yeah, it's different. It's definitely different. Oh, and then the other point too was our friend at NVIDIA has made the point that we've been making. He said, yeah, all these jobs are getting cut by AI, and they have been for like at least a year or so. He goes, AI is not even like anything right now, like nothing as to what it could be. He's like, these companies are full of it. We were like, I was like, hey, where have I heard that before? Right. So they're basically just hiding behind the AI to fire people. And even Altman and the guy from Anthropic took back a little bit of their comments about how AI is going to destroy every white collar job there is.
Right.
So I wonder what's going
on. You're starting to see the rebellion, right? And not necessarily with the jobs, but you're certainly seeing with the data centers. Like all of a sudden, here in Loudoun County, you realize that, wait,
you guys are the epicenter for the data center.
Yeah, and I think we talked this. Remember the great Jack Nicholson movie, Chinatown, and that was about I think that was right around that time in the post-war when all of the fruit growers and the almond growers in California, the big wealthy, were siphoning all the water basically away from the city and to their thing. And it's kind of the same thing on steroids, right?
Yeah. Did you see what AOC did the other day?
Uh,
She was speaking in Congress, and she put a water glass, and it was brown. And she said, "This is the water from like someplace in Georgia that they just started building a data center on." I was like, "All right, here we go."
yeah, then there was an article this morning. I briefly I read a bit of it. I didn't get a chance as we were coming on the air. But it was about how companies are now they have these budgets, right? And these are non-tech companies, but they have these budgets of how much you have, and basically pushing everybody to use AI and spending a lot of money, and they've already blown through their budget, and they're not seeing the return. Like basically they've spent a lot of money, they've forced everybody to use AI. And you know when they tell you to, I mean, it sounds great in the paper when guys say this, but then if you went down to the real level, the company level, you could just see people getting these emails and going, "What in the fuck does this guy talk?" Like, like it's it's probably the execution is nowhere near like, oh yeah, let's just switch over to AI. It's like, telling the employees to do something without really understanding what you want them to do or how to do it, right? Just do it. Or you're fired, right? I mean, like a lot of the big consulting firms, it's like either you have a time budget of how you have to use AI, and if you're not doing it, you're out, which is,
Well, and they're pivoting to pushing this onto all their clients. So
sure.
they have to be able to walk the walk and not just talk the talk.
Speaking of walking the walk and talking the talk, Kevin,
Mm.
first of all, I want to let you know that I am on my ETF TONX on Toncoin. 2 days ago, I was up about 22%. Now
Hmm.
I'm up about 10%. It's kind of
Yeah.
funny every day. But anyway, you had a great call on Toncoin and Telegram, and we'd like to now educate us, Richie and I, as well as our listeners, kind of like let's take it step by step. Like you were saying, maybe we talk about Ethereum first and how all that works and what a protocol is, what a smart contract is, and just do a little education, Captain.
Yeah. Yeah, sure. The first I would add a tiny bit to the ton coin. And we talked about, I believe we talked about the TonX, so this treasury company, and it's done well over the last few weeks because the remember the key thing for it is that it trades at a big discount to the value of the ton coin that it holds. And 2 weeks ago, that discount to NAV, as it's called, net asset value, was 65%. And I haven't looked at, well, it hasn't opened yet today. It's about to. Yesterday, it was 50%. So the all of the return is the compression in that discount to NAV, which that was part of the long-term thesis is, hey, this discount to NAV is crazy and it's going to compress. But it would be nice to see the underlying participate in generating gains as well. So fingers crossed. But yeah, so let's talk about why what a smart contract is and why it could be a really big thing for investors and investment. And Ethereum is the original cryptocurrency that was a smart contract platform. So let me unpack that slightly. So the first crypto, of course, is Bitcoin, the big daddy, and it is seen as a store of value and digital gold, and it is the first blockchain, and I'll explain later why that is significant. And it does its role extremely well. It was explicitly designed as something to be digital money. Um, but what people soon realized is that you could build what's called a smart contract platform. And a smart contract platform basically just allows you to execute computer code on a blockchain. And Bitcoin cannot do that very well at all. And so this thing, Ethereum, was created specifically to be a smart contract platform. So fast forward, what does that mean? What is a smart contract? Basically, it is the foundational infrastructure for decentralized programmable financial markets. So it's the settlement layer, and it facilitates transactions which execute automatically, and have some important characteristics that distinguish it from the traditional financial system. Some of the key ones, it's open source and open architecture. What does that mean? It means that anyone can engage in it. So, and it's permissionless, I should say. And I'll come back to that in a minute and why that's important. So you have this thing, Ethereum, which becomes a permanent record of all transactions that happen in Ethereum, and they are contained in the Ethereum blockchain. So it's a ledger. It's like Ethereum becomes the custodian, or in some cases, administrator too. So many of the people who listen to this will be financial markets people, or at least people who pay attention to financial markets, right? So
So a
I think,
custodian, so Kevin,
yeah,
so yeah, so a custodian, if I'm understanding right, so like the big custodians in the regular financial world are State Street, Bank of New
yeah,
York.
yeah, exactly.
Basically, when you buy a bond, that bond ends up being the custodian is Bank of New York or Boney Mellon, Bank of New York Mellon, and they are responsible for holding that security, making sure that the interest payments come in or go out, the principal goes in. So that's where security is housed. And you're saying as a custodian here, it's away from the regular financial world. It's the blockchain world. Is that
Yeah, it's the registrar. It's the
Mhm.
ownership record.
Who owns
And
what
so
and who
who
owes
owns
who?
what? Who
Yeah.
owns what? And so like I have an Ethereum wallet. What does that mean? So it's a an address on the Ethereum network. You can look it up, and you can see, if I told you what my wallet address is, my public wallet address, and it's for Ethereum, I think it's 28 characters. And so small case, uppercase A, numbers, symbols. And so if you look on the blockchain, you will see everything that that Ethereum address uh, owns. And so it could be Ethereum tokens. It could be tokens in any network that is built on the Ethereum network. So Uniswap, Aave, some of these other things.
So that you could see,
So
so I could see what that wallet holds.
you can see what it holds, and you can see every transaction that it's ever made.
Mhm.
And this is all public. And it So that's a very important distinction between the legacy systems that you talk about, like Bank of New York or State Street. And also the important thing I mentioned that I think I mentioned that they're open source and open architecture on Ethereum. So what does that mean? It means that anybody can transact on the network. There are no gatekeepers involved. So if you want to, uh, trade financial securities on not just the US market, but any market around the world, you have to have a broker. You have to have Charles Schwab or Goldman Sachs or whoever else. And they are allowed to engage with NASDAQ, for example. You and I can't go trade on NASDAQ. We would have to get licensed to do
Mhm.
so. And that adds cost, and there's a gatekeeping element to it. Goldman Sachs is going to do a KYC, like, well, you don't have enough dough for us to open an account for you. Go down to Robinhood. They'll take your money. Um,
And KYC is know your customer.
know your customer, right? And also when transactions happen, what is it now on US equities? Is it T plus one or T
T
plus
plus
two
one.
settlement? T plus one settlement. So you do a
Yeah.
transaction in the market today, and it actually doesn't settle until tomorrow, meaning the final ownership isn't passed on until tomorrow. But if you do a transaction in one of these smart contract platforms, it happens within minutes and in some cases seconds, where the transaction is done. That's it. the value has been exchanged, and move on from there. So the how these systems started was frankly in opposition to the legacy financial systems that existed. And the creator of Bitcoin, Satoshi Nakamoto, in the origin block of Bitcoin, he embedded the text from, I believe it was the Daily Telegraph, a big UK newspaper, talking about how the chancellor had just approved another bailout of the system. And so the Bitcoin was designed so that it could not, that it was supposed to be a monetary system outside of the banking system, outside of the central banking system, outside of government control. And so, that is the origin of all this stuff. Ethereum, it's the same. It's like no one can control this. We are going to create this smart contract platform that once it's deployed, cannot be shut down. And it exists in the ether, and people can engage with it. They can build other protocols which tap
What's a
into.
Kevin, can you,
So yeah, so
protocol?
the Uniswap is an exchange protocol that's built on the Ethereum network. So if you have an Ethereum wallet, you can go um, connect to the Uniswap front end. So it's a web page, basically. And Uniswap is a trading engine. So they have all these markets. Think of it like, you can go on, we talk about Kalshi and Polymarket all the time. You go on and you see all the markets there, you can buy or sell. So if you go on Uniswap right now, they have markets in trading pairs for just about every token that you can buy or sell on the Ethereum network is listed there. So you can, if you have one Ethereum in your Ethereum wallet, you can link to the Uniswap protocol, and you could sell your Ethereum in exchange for Aave, Uniswap, any of these other tokens. And it's a transaction. So you think of Uniswap as like the New York Stock Exchange, and they take a very small fee for facilitating that transaction. And Uniswap was just built by somebody who said, hey, this financial, decentralized financial system needs an exchange. And they built it. And it connects to the software that Ethereum runs on. And so there's no there's no friction there.
Mhm.
And so from there, you also have lending and borrowing protocols. You have insurance protocols. You have derivatives. You have everything, and it all settles on the Ethereum network.
Kevin, can I ask you a question? So right now, so you could exchange Ethereum for US dollars, right?
For a stablecoin,
Sta- Okay.
so yes, you can. I mean, if you have a Coinbase account, then that interfaces with the fiat world.
Hmm.
So once you own Ethereum, then if you want dollar exposure, you can sell your Ethereum for a stable coin like
So what
Tether or
makes
Circle.
Ethereum go up in value?
That's the big, big question. And I think maybe we should touch on that the next, like in detail in a future episode, because don't want to like flood too much in at once. But because there are arguments for how do you value it?
Right.
Now, there is revenue that the network generates because when you do a transaction, like I described through Uniswap, to do a transaction on the Ethereum network, you have to pay what is called gas, which is a bad term, but it's what they came up with. And basically, you have to pay a very small bit of Ethereum to the Ethereum network for the transaction to proceed. Now, this has
So,
varied a lot over the years. Yeah.
so Kevin, are you saying that there's no other way? If I want to transact, I have to go through some sort of exchange like apparatus to do my trading? Meaning, if it's not Uniswap, is it somebody else or
Well, the reason you need the Uniswap is because of the way it's designed. It acts as the middleman, and the trusted middleman, which is important because like if you Richie have an Ethereum wallet and I have an Ethereum wallet, I can send Ethereum directly to you, to your wallet with no middleman whatsoever.
Hmm.
Same with Bitcoin. But in the early days, this is how people bought and sold Bitcoin. They would go meet somebody at a Starbucks, for example, and you'd say, I want to buy $500 worth of Bitcoin. They'd have their laptops there. They'd do the transaction from, your wallet to my wallet, and then I'd hand you over the cash. So
Wow.
if you like, if I could send directly to you, but I have no recourse to get paid if you decide not to pay me. And so
Right.
that's why these exchanges like Uniswap were set up, or lending protocols like Aave to act as that counterparty to deal with the trustlessness of the network. Because if I've got my account at Goldman Sachs and I want to buy or sell on, securities, I don't worry about the securities failing or that trade failing because Goldman is the trusted intermediary, and they're trading through Nasdaq with whoever else, Citadel, and so
So,
in the
sorry,
so yeah,
question. So let's assume that Richie is wants to sell something, Bitcoin or whatever, to you, right?
yeah,
So what you're saying is that, so if I'm gonna, the smart contract is like the smart contract takes care of all of that, right?
yes,
Meaning it knows, okay, debit Richie, credit Kevin, cash.
yeah,
I mean, it does so it's basically the financial system.
yes, and where this has really exploded is the use of stable coins. And what a stable coin is they can exist in any currency, but the big ones are all pegged to the US dollar. So the ones you've probably heard of are Tether and Circle. Tether was really the first, I don't know if it was the very first one, but it was the first one that gained traction and scale. And basically, what they did is they opened up bank accounts and said, if you deposit US dollars to us, we will issue you a Tether token in the same amount that you send it. So you send them $1 million, they will send you 1 million Tether to your Ethereum wallet. And now you can take that Tether and do whatever you want with it. Now, what this was initially used for is a couple of different things. One is arbitrage between cryptocurrency exchanges, because in the early days, the Bitcoin price would be different on Coinbase than what it was on an exchange in Japan, and it would be different than the one on an exchange in Korea, China, et cetera. So, some smart, shrewd operators figured out there's an arbitrage to be made here, but they've got to get their money in, between these exchanges. And so Tether was the way to do that, to eliminate the volatility and price risk that you would get from a cryptocurrency that that bounces around. The other big thing it started being used for, especially in Asia, is companies would use it to settle trade invoices, especially cross border. So if you're an Indonesian company and you're dealing with a Chinese company, it can be really hard to, have these financial flows back and forth. But if they settle using Tether, it happens instantly. It's a lot cheaper than going through their local bank. And so there's a real use case there for it. So let me put some numbers behind this. And let me step back again. Remember, every time there's a transaction on the Ethereum network, there's a small fee that gets paid into Ethereum. And that's often in a lot of these protocols, that's used to like buy back and burn existing tokens. And so it's like a stock buyback. So that's how the valuation, makes its way into the company. So last year in 2025, um, the Ethereum network handled $18.8 trillion in stablecoin transaction volumes, and that was over 2 million transactions per day. And in the first quarter of 2026, the stablecoin volumes keep going up. So first quarter 2026, 8.5 trillion US dollars in volume, over 200, well, just 200.4 million transactions. So the that gets to, okay, this thing, it's clearly being used. The use case is clear. How much can it grow? What's the value to the network from all of this activity? And that's where you get into discussions over what's the proper valuation method. And that is, I mean, you look at Ethereum, it's at $2,000 today. Down significantly from its all-time high. It was, above $5,000. Yet the stablecoin volumes have gone through the roof in activity. So it's being used, but there's still a question of what value actually accrues to the network. And so um, I'll tell you the blue sky um, uh, valuation case and business case for this. I mean, you see it, so you heard those numbers. It's already being used a lot. The the people that get really excited are excited because they think, hey, wait a minute, when all these AI agents transact, it's much easier for them to transact using cryptocurrency because of this permissionless system, because they can't get KYC. How do you get an AI agent a bank account? You can't. Now, I know that there are some in the traditional finance industry who are tackling this a little bit. Like some of the credit card companies are rolling out programs where they can facilitate payments with AI agents, but it's not as efficient and cheap as it is with a cryptocurrency, because remember this, that there's basically zero cost to run these networks, um, because it's all done automatically. The code is out there and it executes. So I should have looked this number up before. So the number I used to love throwing out there is, so Coinbase has 3,000 employees. I'm sure it's different today. This is a while ago. And the Uniswap Foundation that works on network upgrades and whatever had 30 employees. And yet the two networks were processing the exact same trading volume. So 3,000 employees versus, so just the overhead is just, it's 1% in these new systems that facilitate these transactions on these blockchains. You're talking about 1% of the overhead of a Goldman Sachs or a Bank of New York or a NASDAQ. And so if these markets grow and become the markets where real transactions happen, which has happened for stablecoin, you can certainly see, the there's no marginal cost for an additional marginal transaction. It's just it all goes straight to the bottom line.
But Kevin, but now when Ethereum, the value of Ethereum to a dollar, or I guess to a stable coin like Tether, it's kind of the same thing, right?
Yeah.
So that's bouncing around all over the place. So
Yeah.
how much of friction does that add to transacting when you're either holding I mean, do you hold stable coin and then you want, like, do I hold Ethereum in my wallet and some stable coins, or do I hold one or the other?
That's up to you. It's,
Yeah.
it's really no different than, let's say you have a brokerage account at, Schwab.
Hmm.
Do you keep some in cash, or, are you fully invested in equities?
Right.
There's also ways you can take the Tether and other stable coins and earn yield on it. So it's basically like earning interest. And now this is the key issue that's holding up the Clarity Act legislation in the Senate, because the US banking industry is they're scared that if people can earn interest on stable coins, then they're going to move their money out of the banking system, which is not paying them interest on your
Sure.
deposits at your bank account. And so this is the key thing that they're wrestling with the language to prohibit just passive earning of yield on stable coins, because that would directly compete with and threaten the traditional banking sector's bank accounts.
They must have had to come up with some real good BS to fight this one, right? I mean,
Well, they're saying that look, it'll destroy the banking system, and then the banking system it supports all the lending and economic activity in the country. So and they're not wrong. It is a threat to that. But at the same
Sure, what I'm
time,
saying is
I've
that,
got a Citibank account, savings account that pays 0.01%. It hasn't changed in 10 years, even
right.
though
So
interest rates are up. So, it becomes a political question.
yeah, but now that there's an alternative, it becomes glaringly obvious of just how banks get away with holding your cash and giving you absolutely nothing.
Yeah.
That's what I'm saying. The BS argument's going to be that they're going to come out with all this nonsense about the stability of the banking system. But the reality is you're going to increase the cost of funds for these guys, and that's where they make the money.
Yeah,
When I
and
was
at the
at
same time, look, you could buy a money market fund instead of leaving your cash sitting in your savings account at the bank, and that didn't destroy the banking industry.
Well, it almost
So,
did, right? I mean, at 23, when all of a sudden everybody realized at the same time, wait a minute, I could just click this button here and I could take the money out and put it into a 5% treasury bill. I literally remember the day or two before everything blew up. I was on Bloomberg and I must have had the same conversation with 10 people. Like, yeah, I'm putting my money into a CD. Like I'm gonna put my money into a 1 year CD at 5.5%. And everybody did it at the same time. And it almost blew up I'm not gonna say it almost blew up the whole banking system, but it certainly caused a lot of problems with Silicon Valley and all the rest of these guys.
Mhm. Funny. Yeah, I remember thinking about the this Clarity Act and all this stuff, the BS argument. When I started at JP Morgan, it had just the summer I started, I was in the training program, and the Federal Reserve had just approved, after, I guess, 60 years of separation of commercial banking and investment banking. And JP Morgan was chosen as the first entity to get those powers back. So they could trade in securities. And there must have been, I don't know how much money spent by Goldman, Merrill, Morgan Stanley on Capitol Hill. Like, these guys are going to wreck the system. They're going to wreck everything. Like they don't know what they're doing, right? They're a bank. They're a commercial bank. They lend. They have branch offices. And basically JP won, right? Because they had some deep pockets too.
Yeah.
And I think it was like at the end, Goldman was like, all right, well, at least if it's them, they're probably not going to screw it up. They're going to take money out of our pockets, of course, but
Right.
all right, all right, go ahead. And that's what
and
happened.
there's an argument that these stable coins are actually will be over time a big net benefit to the US and the US dollar because again, anybody from anywhere in the world can spin up an Ethereum wallet and they can buy and hold Tether or Circle, the stable coin. Well, who's that a benefit for? Well, one place that this is really like where there's huge market penetration is Argentina, which historically had big problems um, with inflation and currency debasement, and they have capital controls, and so the people there have bought. They've been big holders of Tether because it's a way for them to have savings in US dollars. And it's a
Mm-hmm.
lot cheaper than going into the black market and constantly doing that. And so,
And
yeah,
what is Tether own? What is Tether and
US
Circle own?
treasuries,
Right.
that's the big thing. And that's where this argument can be that, looking for ways to fund the US government deficit with you got maybe the Japanese owning, holding less, the official institutions, Chinese, Europeans. But if suddenly you have US treasuries that become available to everybody in the world with a little bit of money to save, then it's an argument. How
Another,
compelling it is, everyone's gonna have to decide for themselves. But
oh, I bet I mean, it's just another way to kick the can further down the road.
Mm-hmm.
Like we're
yeah,
coming to a reckoning. Wait, hold on. Like now, does that help the Clarity Act get over the hump where you got the White House and you got basically Bessent and you got Congress and look, guys, if we do this, like we can roll this thing because look, like we talked about before, just bonds, the 2-year note to the 30-year bond, it's about 385, $86 billion a month that I've been seeing, and it's only going to be going up, right? And
Mhm.
like we talked about before, is that Mr. Warsh does not like this gigantic, big $6.7 trillion Fed balance sheet. So he wants to start. Now, granted, like Richie, you said, I don't want to go too off course. You said, well, a couple few weeks ago, like it's not a dictatorship. Walt Warsh just can't come in and say we're doing this. But the arguments are definitely going to be had, and this is going to be one way to do it, right? Is okay, we're gonna start reducing the balance sheet on the long end of the curve. We're going to start doing more on the short end of the curve, T-bills and things like that. And then we come back to your, I think Kevin, you brought it up one time about that's the classic emerging markets crisis. Is okay, we nobody wants our 10-year debt, but we got to issue and every month or every 6 weeks, we got to make sure people come in to buy more. Well, here you go. Like if
Until
the
they don't.
buyer,
Yeah.
unlimited stable coin, they got now granted, like Tether, right? I mean, has Tether actually had an audit yet? Isn't that where they still haven't had an audit to actually show exactly what they own?
Yeah, I mean, we could talk for a couple of hours
Sorry, I
just
didn't mean to
about
go into
that.
the.
But they've had an attestation. Now,
Yes.
here's the thing that I think we'll summarize this very, very quickly. Um, the There certainly was a time, I don't know, 4, 5, 6 years ago, when there was a hole in Tether's balance sheet where, so, they, if there's 100, or let's say there's a billion Tether out there, then there should be $1 billion in a bank account somewhere that is backing up those stable coin. Tether was getting chased by U.S. authorities all around, and they kept having to close their bank accounts and reopen them someplace else. They got into a situation where the people who owned Tether also had an interest in a cryptocurrency exchange called Bitfinex, which got hacked, and money was drained from it. Tether stood behind them. Anyway, long story short, there was probably a point in time where Tether was probably only had about 80% backing for the Tether out there with cash in a bank account.
What wasn't some of it in Chinese corporate commercial paper?
Yes. Yeah. Yeah. And now what they've done in recent years is because, look, the Tether is probably the most profitable financial institution in history by per employee. And I'll get the exact number wrong. I think Tether has something like 100 employees, and last year they made as much profit as Goldman Sachs did. And the reason is because they earn the float on all this money deposited to buy Tether. So it's something like, I want to say it's about $90 billion. I'll probably get that off, but so they're earning the float on that, which is huge. And so they've been able to earn their way out of the hole on their balance sheet over the last few years. And they did switch to owning, I think the number is around 85% of their holdings, their assets are in treasuries. So some form of treasury, and their custodian for that is Cantor Fitzgerald. And so our friend, I'm blanking on his name,
Howard Lutnick?
Lutnick, yeah. So he came out a year and a half or 2 years ago, and he said, Tether is fine. I've seen where all their assets are, and we're holding their bonds. I'm very comfortable with that risk. And I think once he came out and said that, I was like, okay, we don't really need to worry about this for now, because he's putting his entire company at risk if this money wasn't there. And so once he made that statement, I think the Tether risk dropped significantly.
Interesting. Now, just one more thing because we have uh so when you think about the fact that they were making all this money, now granted, when they were holding treasury bills in the last decade, they were earning nothing on them.
Right.
So that's the potential risk, right? Is that big that's why they needed to go out and buy Chinese commercial paper and all kinds of other stuff to earn, essentially.
Absolutely right.
Gotcha.
Yeah.
Because at first I was going to say, these greedy bastards, like, I mean, they're already making, what'd you say, 80 billion dollars in just float income, and they have to,
Well, no, that's the amount outstanding. So they're still making, billions a year. And
yeah.
they're still, I mean, right now, if it would make sense for them to put everything into treasuries
Hmm.
and publicize it, because then they're like, look, all the fear stories out there, they're nonsense. Look at the
Right.
float we're making. But they're still, it's not completely backed by liquid treasuries. They've also bought a lot of gold and they bought a lot of Bitcoin, which,
Hmm.
okay, as an investor, I'm sure a lot of people listening here have bought a lot of gold and Bitcoin, but their business is just,
Yeah.
is earning risk-free interest income. And the more secure people are with your network, in theory, the greater deposits they'll put into it. And you can make even more risk-free income. But, going and punting around with gold and Bitcoin, it's like, guys, come on, what are you doing?
Yeah, well, do you remember when they closed Lehman down in 2008, and all of a sudden everybody realized, oh, they borrow a lot of commercial paper, and all these money market mutual funds own that. And as we know, this audience is that a money market mutual fund, it's called, you can't break the buck. It's got to, well, money in there has got to be worth a dollar. A dollar has to be worth a dollar. And all of a sudden, when Lehman went down, all of a sudden a dollar wasn't worth a dollar. And that was actually the day that the system really almost crashed. I think
Yeah,
remember the oldest money market firm in the planet, I can't, Reserve Fund, I think it was called.
yeah,
They
yeah.
broke the buck. And then you remember Putnam slammed the gate down. And I remember looking at my wife and going, like, if someone doesn't come out here soon, because I had the Bloomberg up, like, and say everything's okay, we're at home right now because that was after I was at work, and it's like we're home now. Everybody else is in the city, so we'll be able to get down to the bank before before these guys can
Oh,
get off the train.
and some people say it was like half an hour away,
Yeah,
like a half an
yeah. And I should remember that. I think Paulson, Bernanke, they all came out like 10 minutes after that happened. Everything's
hour.
okay. The banking system, I could just
Nobody run down to the bank.
right. So you can make an argument that these guys, if they're going to do this, then they should be regulated, right? I mean, there should be some sort of a governmental control or something to regulate them and make sure, which means there should be audits and there should be, it should be operating like a money market mutual fund.
And there are now. And in the act that was passed last summer, the Stablecoin Act, I'm blanking on it now, um, that did pass both the House and the Senate, did establish rules around, at least within the US, the stable coins had to have US Treasury assets or high quality bank deposits, things like that. And it
Mhm.
established what they had to do with their assets. The thing with Tether is they have a US entity and they have a global entity. And it's the global parent entity that, excuse me, that has, the gold and the Bitcoin.
Mm.
Okay. Well, that was a good that was a good like little lesson there on smart contracts and on Ethereum and on just pretty much an ecosystem where really you basically described a financial system.
That's the hope. And
Yep.
that's the those who are betting on this by buying the tokens in Ethereum or Uniswap or others, that this is the vision. Like, this system makes sense. It's open to everybody. It has a fraction of the cost. It's classic early stage growth industry. And so, value it like a VC values something. You're not looking at PE ratios and price sales ratios today. You're looking at how big is this market, and is it, can we see a future where you get the hockey stick growth curve, and then the PE in 10 years from now is what matters, not the PE today. And that's basically where we are in the investment cycle.
Sounds good. Okay, and then next week we're gonna tell you how you should not walk but run to buy Tonex and and Toncoin. Just kidding. Um, all right, Rich. Before we go, any thoughts on the on Spurs Thunder?
Yeah, I think it's going to be Game 7 on Saturday. I think it's Saturday. Maybe it's Sunday. I don't know. But Game 7. This is what the league wanted. Um, the first game was like an instant classic. Game
Yeah.
one of the series. It went back and forth, double overtime, crazy three-pointers at the buzzer by Big Wemby. Every other game has sucked. Like even though they're even, they
Blowing
both
each other
won
out.
three. The average margin is like 18 or 15, something ridiculous. These
Yeah.
games are like blowouts either way. So I'm going to go with my zigzag theory, and I'll take the Thunder minus 3.5 on Game 7.
All
Although
right.
I kind of it would be neat to see the Spurs make it, but I don't know. It's going to be the game is in Oklahoma City, so it's
Mm.
usually hard.
Okay. All right, everybody. Good seeing you guys. We'll talk next week.
Awesome.
See ya.
See ya.